Next guest. Banking crisis worsened mortgage-backed securities market. Spreads have worsened since crisis. Housing market stabilized on November 9, 2020 when rates fell from 7.37% to 6%. Rates have fluctuated since. Disinflation weapon as mortgage rates. Regarding housing, if prices stop growing at 0%, it won't have a significant impact on core CPI and overall inflation. During the housing bubble, core PCE was at the Fed target level despite high home price growth. Rent inflation is the main factor affecting CPI, and it has been decreasing. Rent inflation lags behind CPI data, so home prices don't directly affect it. Rent growth will lower CPI data in about 12 months. The Fed must endure inflation and avoid a job loss recession to reach their 2% target. Rate hikes and credit tightening could lead to job losses, making it an ineffective approach. Discussion yesterday focused on Case-Shiller and the top 20 cities with negative year-on-year growth: San Francisco, Seattle, San Diego, and Portland. The journal's map showed negative markets west of Colorado and positive markets east of Colorado. It's unclear if this trend will be limited to the western quarter of the U.S., as total active listings are near all-time lows in new listings data as negative year-over-year. High housing inflation growth areas will be affected, but not as severely as during the 2006-2007 distressed sales period. A prolonged job loss recession could worsen the situation. Only areas with rapid home price increases will experience significant housing hits. Stability in other areas indicates successful credit channels and longer home ownership. It is possible to combat inflation without causing a job loss recession or a repeat of the 2008 to 2011 housing crisis.